Yo, what's up, everybody? Still out here in Los Angeles. So, I was talking to a friend of mine today. We were just talking about trading, and he was having some struggles with, he was trying to do like real short term day trading in and out, stuff like that. It wasn't working out, which I was not surprised because, it's just the game is rigged, folks. And as I was talking to, and I can say that because many of you know that I was a former member and floor trader on four futures exchanges, the Chicago Mercantile Exchange, the NYMEX, the COMEX, and the New York Futures Exchange. So I was down there for many years in the pits, trading as an independent trader. That was pre-electronic trading days, and that was the wild, wild west. That was real short-term trading. That was seeing order flow. It was a whole 9 yards. I talked about that many times. Anyway, I was telling him a story one time back in the 80s. At that time, I was a member. I had memberships on both the NYMEX and the COMEX. I knew this guy. He was a very, very wealthy Egyptian guy. He was based in Switzerland, but he was in New York, and he invited me for lunch. By the way, the reason for this story I'm going to show you is how the game is set up for the benefit of the Wall Street banks, the players, and it's against you. Okay, and if you think what I'm going to tell you now is, an example of how far or how much it's rigged against you, it's even worse nowadays in the electronic trading days, and I'll get to that later. But anyway, this guy, very, very wealthy Egyptian guy, and he invited me to lunch, and he said after lunch we'll go up to Morgan Stanley. He had his account, his trading account with Morgan Stanley in New York, and Morgan Stanley at that time was, that was the whitest of the white shoe Wall Street firms. That was the elite firm. It wasn't Goldman Sachs. It wasn't Solomon Brothers at that time. It was Morgan Stanley. Okay. And so we had lunch, nice lunch. And then he took me up, and that was a privilege. Like, not anybody could just go up there. So we went up and we went onto the trading floor at Morgan Stanley. Morgan Stanley's headquarters at that time in the 80s, it was on 6th Avenue, Avenue of the Americas. I believe that was the old Exxon building or something like that. I don't know. It wasn't on Wall Street. It was in Midtown, and it was on 6th Avenue like in the 50s. So we went up to their trading floor, and I sat. He said, hang out. Everybody knew him there because he was a big, big customer. And I sat next to the guys who were on the futures desk, they were doing index futures mainly. They were trading S&Ps in Chicago. It was a whole desk of guys. They were on the phone with the floor in Chicago. And so they were situated there. And then right over to the left of these guys in another area of the trading floor. It was a big trading floor, but they had a lot of, traders. All right. I'm going to explain that. So next to these guys in another quadrant, another area, was their block trading desk. The block trading desk, these are the guys who were taking big, stock orders from like major institutions. Okay, they would get like orders 100,000 shares, 500,000 shares at that time. Those are huge. These are the biggest orders. The biggest order flow, right? It was coming through their desk. So I was watching what was going on, and now I'm sitting next to the futures traders on their desk, and over there on the left, you hear the guys. They're all standing up. They're on the phones. Buy 100,000 GE, buy 300,000 telephone, right? So the S&P guys, They're listening to this order flow coming through the desk, and it's all open outcry. They're shouting out the orders for a reason. Okay, number one, as they're screaming out the orders, somebody's executing it. There's another person who's executing it or making a market for it. And then the S&P guys, they're hearing the order flow, and they're hearing that order flow before it hits the floor of the New York Stock Exchange. So what do you think they're doing? They got an open line down to the CME, down to the pit in Chicago, the S&P pit. They're like, buy 50. They're buying 50 futures contracts. Buy 100. Because they know as soon as those orders hit the tape, what's going to happen? The market's going to go up. And that's exactly what was happening. They'd go buy 50, buy 100. And then, the S&P would rally like 100 points, which back then was a big thing in those days, even 50 points. And then they're out. They get out. So they was scalping these trades, and it was just like shooting fish in a barrel. It was like a cash machine for them because they saw the order flow. So like, you can't compete with that. You just can't compete with that. Now, even us guys on the floor, when we saw the order hit the pit, like let's say there was a big futures order coming in, like if I'm standing in the S&P, when I was standing in the S&P pit in Chicago, let's say the Morgan Stanley guy, he comes in, and unless he told you, which he was not supposed to do, you got to kind of read his his body movement, to try to guess what he's about to do at that minute, and then you front run that, you jump in front of it, right? After a while, like some days, they would be buyers like all day long. So like every time that guy came into the pit, you knew he was going to buy more. So you start buying because he's in there with another big order. But it just go, and as much as an advantage that we had, like over everybody else, especially, outside the pit, especially amateurs like you guys or whatever, or, regular investors. These guys at the big brokerage firms like Morgan Stanley and Solomon Brothers and Goldman Sachs and all the big firms, they had this setup where they had their customers, the big institutional clients, buy 100,000, buy 300,000. They knew, they saw the order flow, and they went against it. So, I'm not, okay, you can call it rigged. You can call it whatever you want, but that's the game. And the reason why I said to my friend, like, you don't want to be in that game. You're just going to lose. I don't care what service you sign up for. I don't care what technical charting service or you don't want to be in that game. Long term, you cannot win. That's like basically going to Vegas and playing the slot machines. Once in a while, you might hit it big. I'm not saying no. But it's like over time, you play the slots in Vegas, the casino is going to take your money. It's just set up that way. And over time, you try to play this short-term trading game, and I'm not just talking about day trading. It could be like you're trying to do swing trading week to week. The casino, which is Wall Street, is going to take your money. And the same thing on the deal side, On the deal side, let's say Goldman Sachs right now. That's why I laugh when they when I meet these guys, very rarely nowadays, because, I don't really hang out in that realm anymore. I don't really hang out in that, environment. But if I meet somebody or I hear somebody talk about how they're a trader at Goldman, they're not risking their money. I mean, they have everything they do. These firms have a built-in edge. If Goldman is executing an order for a customer, they already have the other side locked in and padded with a profit. Okay, they're making a market. These are market makers. These are not traders in the sense of, they're putting their money on the line as a bet. And if they did, they'd be big losers. I mean, there was a study done once. I remember it was even published, I think, in the Wall Street Journal about how, all of gold, not all, but something like one year, Goldman, out of 13 macro calls, like forecasts. They got 11 of them wrong. Okay, so they got these guys, these analysts who are you sometimes maybe read their stuff online or zero hedge. So and so says this, so and so says that. They don't trade. Those firms don't trade off of that advice. That's just content for clients. Okay, Goldman, Morgan Stanley, if they're doing a deal, they're doing both sides where they lock in a profit for themselves before the deal is even done. Okay, it's kind of like almost like an arbitrage. Like a customer wants to buy something, stock or a commodity or something, they'll make a market. They'll be on the sell side, but when they're on the sell side, they're already locked in the buy side at a lower price, or vice versa. If a customer wants to sell something, a stock, a commodity, they'll make a market for them, and they already have a sell side. And actually, when I first started out, and I think I've told this story before in the past. I know I have, but when I first started out on the New York Futures Exchange as an independent floor trader, and I knew nothing really at that time, but it was at the very beginning of stock index trading. All right, it was like New York, Chicago had just launched the S&P. Actually, even before the S&P, they launched the Kansas City Board of Trade actually had the value line index. I don't even think that exists anymore, but but on the New York Futures Exchange, after a few months, I got the hang of it. Like, I'd stand in the pit and there was enough order flow coming into that pit where, I could just make a market. Like, okay, what the price is trading at, let's say 40 bid at 50 means I'll buy them at 40, I'll sell them at 50. Okay, so some broker hits me at 40, I bought them at 40, I could quickly turn around and sell it at 45. So it's like I'm trading for a tick. One tick every time. And worst comes to worst, I scratch the trade, meaning I'll just do a break even. And that was like a cash machine for me. Like, every day, it was like printing money. I would be able to go down there. But then after a while, all the order flow to business moved to Chicago. They were much more savvy about promoting their contracts in Chicago, and the S&P really took off. And the New York Stock Exchange, which is crazy because our little exchange, the New York Futures Exchange, was physically connected to the big board, the New York Stock Exchange. I mean, I used to walk across a little hallway and I was right on the floor of the New York Stock Exchange, but the specialists on the floor back then, they didn't care about us. Even though, we were their little, infant baby, they didn't try to support us. They didn't try to put orders through, nothing. They didn't care about us. So eventually the knife died out. So I told that story, but nowadays it's the same thing. I said I was going to talk about nowadays. Nowadays with these algo things, the way the algo things are kind of set up the way, kind of like what I saw at Morgan Stanley back in the day, back in the 80s, that the algo, basically computers that are linked into the communication lines, and they see the orders coming down the pipe, and so they jump in front of that. And then they'll just immediately get out with a profit. And it might be a minuscule profit. It might be a tenth of a point or something like that, but they'll do that millions and millions of times. So it's the same rigged system, okay? And you can't go against, you can't beat that. That's why I tell people, and people don't like to hear this because they think they really approach this whole investing game the wrong way. They approach it like, I want to make $1 million tomorrow. I want to put down a big bet and I'm going to, it's like some kind of gambling mentality, and it's not. You really have to, in order to do well, you got to take a macro, long-term perspective. You have to have patience, and you have to understand the power of compounding. Like, it starts off slow, but over time, I always come back to the example of Warren Buffett. The guy's like the fourth or the fifth richest guy in the world. He never invented anything. He never created a new industry, no new technology, nothing. He invested in stocks, and for most of his life, his stocks were like boring companies like Coca-Cola. I mean, he didn't even get into technology really until the early 2000s, maybe even the mid 2000s, when I think his first investment in technology was Apple. Okay, and when that was when Apple, there was a big correction. It was maybe around the time of the financial crisis. I don't remember, but Apple, and he finally came in and he bought Apple. That was his big first investment in technology. But his whole story has been about like accumulation of good assets, the understanding that, wealth is basically can be this boiled down to a growth function. If you understand what a growth function is, you can plot it on your Excel spreadsheet or something. I mean, it looks like a flat line for a long time, and then it starts to slowly pick up, and then it goes parabolic. But most people, they don't want to wait this long time. All right? I used to give talks, and I used to say, if you take a newborn baby, and it's a shame they don't teach this like in school. They don't teach the right things in school. It's crazy. But if you take a newborn baby and you just put away $50 a month into like an index fund, you don't even have to pick stocks, an index fund. By the time, and you can go do this on one of these retirement calculators, $50 a month, with the average annual rate of return of stocks and the compounding of interest and dividends. By the time, and most people can afford $50, by the time that baby's 65, ready for retirement, there's like a few $1,000,000 in there, no problem, that has built up over time. Now just imagine if you did that with a little bit more money, and then when there are like market corrections, you get more aggressive. Instead of putting 50, maybe you put 100, or if you're doing 100, maybe you put 200. But everybody does the opposite. They want money like right away, or when it goes down, they sell out. And then when it goes up, they go chasing after it and they buy into it. How do you expect to amass any wealth doing that? And here's a final thing I will leave you with, which I said to my friend. Buffett's partner, Charlie Munger, I think he's also like around 90. Both of these guys like in their 90s, right? Buffett's definitely in his 90s. Charlie Munger, I mean, some of his ideas and some of his things are kind of wacko. Like he's definitely not an MMT guy, and lots of times he talks about the debt and stupid things like that. But I remember watching an interview with him one time, and he was asked by somebody, when do you sell your stocks? All right, seems like a normal question. And Munger was just like taken aback, and he was like, why would I sell my stocks? I don't sell my stocks. Like I spent my whole life accumulating good assets. Why would I sell good assets? And this was such an amazing point. And frankly, it's something that I say to people because I've learned this the hard way in my life. There have been a number of times in my life where I had some really good assets and I sold for no particular reason. I just thought, oh, they're high enough. Like some arbitrary stupidity. They're high enough. And I sold. And that taught me a really, really powerful lesson. You never sell good assets, okay? And your whole goal should be, over the course of your life and your investing life, the accumulation of good assets. Those will take care of you and your family and your kids and your grandkids. If you do that, those assets will take care of you and everybody else who you want to, be taken care of. Accumulate and do it wisely. Like, you got to reframe your attitude. Like, market corrections are gifts. They're just like here. Imagine if there's if you have some item you've always wanted. I don't know, whether it's like a really cool car or, like a great watch or something like that. And you're waiting, you say, when that thing is on sale, when I could buy that, on the cheap as a bargain, and I know the value of that, I'm going to go in there and I can't wait until that day when I can get that. And that should be the same attitude when it comes to stocks. And when they go down, you should be happy about that. I mean, but it's just like a crazy thing. Like, that freaks people out. Yeah, and I get it. Like, you look at your portfolio and it's going down. Like, I go through the same thing. I'm not saying look, last year I was more angry than stressed out because I saw a lot of irrational selling because, interest rates are going up. I mean, I tried to explain here 1,000,000 times, what it means when rates change. It's just all it is. It's a price change and a redistribution of income. So is inflation. So is deflation. Okay? So, I mean, so most people don't understand this stuff, and they listen to the misinformation and they freak themselves out. So anyway, that's it. The game is rigged. Don't try to play their game. Believe me, folks, I was in it. Don't try to play their game. All right? Be smart. Play your game and make that be the long game, and just focus on accumulating good assets. That'll take care of you for the rest of your life. Have a good one, everybody.